2015 will see a big ramp-up in railway investment. That was the word from Chinese Premier Li Keqiang's work report. In non-government sectors, investors are banking on a still relatively high growth outlook in China and an increasingly severe consumer population.
Whatever Chinese people are interested to purchase, the market is there. So people are interested in safer food, people are interested in cleaner air, people are interested in a better car to drive. So all kinds of industries, the climbing up the value-added chain, when you're in that sector, this is a market for you.
For 2015, analysts say opportunities lie in healthcare, environment, technology, and of course, infrastructure. But international investors are not as keen on China anymore. Foreign direct investment to China grew just 1.7% in 2014. Unpredictable legal and business environment also keep investment at bay. The American Chamber of Commerce says 30% of the companies they spoke to have no investment expansion plan for 2015. Meanwhile, Chinese companies are buying overseas assets to hedge weakness at home. Property is the new darling after the resources acquisition boom cooled.
For the first time in 10 years, Chinese capital outflow has exceeded Chinese capital inflow in the commercial real estate sector. One is diversification of the currency, obviously, and with the recent slowdown in the Chinese real estate market, it's also hedging against this market.
After property, another overseas investment target may be infrastructure. EIU's Liu Qian sees China turning into an investment powerhouse.
We believe that within 3 years' time, that is before 2017, China will be a net investor. Nowadays, it's more the soft power that really plays here, as we see the new One Belt, One Road plan.
That's a massive project to export China's infrastructure skills, building transport links connecting Asia and Europe. And it comes with a $40 billion state fund to invest in South and Central Asia. That may even prompt cross-border securitization for China in the Asia-Pacific area. Brett Evans at Atlas Wealth Management sees a chance for the capital power of Australia's pension funds to mesh with that of China.
China's done a great job in terms of rolling out more and more infrastructure to take into account their growth. I think Australia particularly has underutilised and underfunded our infrastructure. The best way to do that is through superannuation funds. There's $1.7 million worth of super money invested in super in Australia at the moment. By encouraging super funds and possibly providing incentives for them to invest back into infrastructure, there's no reason they couldn't do joint ventures with overseas investors.
For the private sector in China, it has always wanted to go beyond the borders.
Nowadays, we see many companies and factories that they're going out, but primarily a predominant reason why they're going out is because they're either interested in the technology and innovation in that particular company they're purchasing, or it's because they want to have access to that local foreign company's market size, because that is more of a developed country.
It's almost certain China's overseas investments will pick up pace in 2015, given its global ambitions. But analysts say it doesn't mean a slowdown in domestic investments. Aside from a government-led build-out drive, investors are waiting for a China-US investment treaty. By breaking down the barriers, the deal would encourage more capital flows between the world's two most powerful economies. Cheng, CCTV News, Beijing.